Hi everyone, and welcome back to the channel. The Federal Reserve is working diligently to try and stop a complete collapse of the banking system. Unfortunately, their efforts may be too little, too late. The Federal Reserve is putting a very small band-aid on a massive wound when it comes to banking. And right now, we need to understand what is going on in terms of small banks and how there's a possibility that other small banks could collapse. This won't just cause pain with investors, it could cause pain for the entire economy. So, let's get into it. As many of you might remember, during the 2008 financial crisis, a lot of the problems that we had were actually due to banks. They were taking mortgages that were poorly credited and lumping them together and saying that they had a great AAA rating. Today, many of the issues that we're seeing actually come from bank deregulation during 2020. When the economy started to take a nosedive, the Federal Reserve decided that it needed to do something drastic. One of those things that they decided to do was actually to allow banks to no longer have a reserve minimum. Previous to 2020, banks were required to keep a 10% reserve minimum to make sure they could meet liquidity demands. That means they were only allowed to make money on 90% of their deposits. Due to the stress on the economy, the Federal Reserve decided that they wanted banks to start lowering their credit requirements, and that's why they allowed them to start giving loans out on this reserve. This also allowed banks to start buying treasury bills with that reserve and start making interest income right away from it. This allowed banks to make instant income at a time when interest rates were very low. This is one of many issues we're seeing in the banking industry right now. Most banks are just not in a good enough position where they can leverage over 90% of their assets and be prepared in case there's a liquidity crisis. And that's exactly what happened to SVB. Now, quick and simple, what happened with SVB is that they had a lot of deposits that were over the $250,000 FDIC insurance limit. Therefore, whenever a rumor started going around that they were having liquidity issues, people that had over the $250,000 amount, which were most of their depositors, started to pull their money out of the bank in a fear. Therefore, that caused a bank run. And in all honesty, the Federal Reserve probably did the right thing during 2020 in taking their reserve minimum away. But as the economy started to trend upward and things looked better during 2021 and 2022, I think they should have implemented this back in. And if they had, we probably wouldn't be having this conversation at all. Unfortunately, as the economy started to do better, inflation hit, and the Federal Reserve had no choice but to raise interest rates very dramatically. This is a great strategy to try and stop inflation, but unfortunately, it's had unintended consequences. The increased federal funds rate made it hard for consumers to get new debt, but it also caused the treasury bonds that the banks had previously purchased to go down in value. That's because interest rates and treasury bonds have an inverse relationship. The ones that you previously purchased go down in value as the new ones have a new and higher interest rate, which makes those more valuable. This is exactly why banks are having it rough right now, especially small banks. If there's a lot of depositors that want their money back, a bank has to go and sell these treasury bonds for a huge loss. And that's how these banks are going bankrupt. These losses on treasury bonds previously went unnoticed, and that's because they were unrealized losses. And when people weren't coming to the bank to get their money out, they didn't have to sell any of these bonds. Therefore, they could hold them to maturity and not really lose very much money. But when you have to sell these bonds that have a low interest rate before they mature, you're losing a lot of money because the new bonds have a much higher interest rate. Therefore, these bonds that they previously owned are worth less. As a result, the Federal Reserve opened up a new program called the Bank Term Funding Program, which is supposed to help banks that have a lot of unrealized losses that they now need to realize. This is all supposed to help banks that cannot afford to take on these losses. And this is a good thing, right? Now, the Federal Reserve came out and made a huge deal about this program and how great it is for the banking industry. But what they didn't tell you is that they're getting a 5% rate of return on these loans that they're giving to these banks. And these banks can't sustain this for long. Most of the funds that they were pulling before were from depositors, and they're getting that at a 1% interest rate, maybe even less. As we know, savings accounts really aren't giving that great of interest rates right now. So that means they're paying 4% more for every single dollar they need to get. That's going to end up hurting them very soon. This point here is what's extremely concerning. If a bank needs to rely on one of these programs, they're going to be paying a ton of interest to what they previously were. That's really going to dictate how much they can profit and what direction they can go with the bank. It also means that they're most likely going to rely heavily and more heavily on this program, and therefore they're going to go bankrupt anyways because they can't afford the interest payments. So why did the Federal Reserve end up implementing this program if it's not really helping banks in the long run? Simply put, They wanted to make sure that there was no contagion and that people stopped creating bank runs on banks. But all this really did was push the can down the road, as there's more bankruptcies likely to happen in the banking sector. And this is all going to happen because people are starting to move their money from banks into treasuries. This is all because treasury bonds are paying between 4 and 5% interest, while banks are still paying 2% or less to their depositors. As people find out all of this money that they're missing out on and they're still investing in something that's essentially risk-free, they're going to move their money towards that to get that higher rate of return. And banks just can't compete. Overall, the Federal Reserve is making some big mistakes. Number one, they did not bring back the deposit reserve that they previously had before 2020. And it just doesn't make sense why they haven't brought it back. It's hurting everyone and it's causing things to get worse. And number two, they're not letting things take their natural up and down, boom and bust rotation that most economies need. They're trying to stop all of the bust and they're making sure that these problems get piled up and you're getting a bigger and bigger problem. At the end of the day, it's all going to be tumbling down and we're going to be stuck with the mess because they can't fix it every single time. They're just making it worse by putting it off. At the end of the day, banks that are too big to fail won't go bankrupt because the government will bail them out. Smaller banks, though, are at a very high risk of bankruptcy, so make sure you're watching out there. Be sure to leave your comments below. Otherwise, I'll catch you in the next one.